Welcome. Today we're diving into the world of fund metrics. Whether you're an investor, a finance enthusiast, or just curious about how funds are evaluated, understanding these metrics is essential. Fund metrics help us measure performance, risk, and efficiency, providing a clearer picture of how a fund operates. In this video, we'll break down the most important metrics, explain what they mean, and show you how to interpret them. Let's start by exploring why these numbers matter and how they can guide your investment decisions. Ready to make sense of the numbers? Let's get started. Fund metrics are quantitative measures used to assess the performance and characteristics of investment funds. They provide valuable insights into how a fund is managed, its returns, and the risks involved. By analyzing these metrics, investors can compare different funds, identify strengths and weaknesses, and make informed decisions. Fund metrics are not just for professionals, anyone can use them to better understand their investment. In the next scenes, we'll break down the most common metrics and explain how each one works in practice. One of the most fundamental fund metrics is the net asset value, or NAV. NAV represents the per-share value of a fund's assets minus its liabilities. It's calculated at the end of each trading day and reflects the current market value of the fund's holdings. NAV is crucial because it tells investors how much each share of the fund is worth. When you buy or sell shares in a mutual fund, transactions are typically executed at the NAV price. Understanding NAV helps you track the value of your investment over time. Expense ratio is another key metric to consider. It represents the annual fees that a fund charges its investors, expressed as a percentage of assets under management. These fees cover management, administrative, and other operational costs. A lower expense ratio means more of your money stays invested, while a higher ratio can eat into your returns over time. Comparing expense ratios across similar funds can help you choose cost-effective options and maximize your investment growth. Total return is a comprehensive measure that includes all sources of a fund's performance: capital gains, dividends, and interest. It shows the overall growth or decline of your investment over a specific period, usually expressed as a percentage. Total return helps you understand the real-world results of investing in a fund, beyond just price changes. By comparing total returns across funds, you can see which ones have delivered the best performance after accounting for all income and appreciation. Annualized return, also known as compound annual growth rate (CAGR), shows the average yearly return of a fund over a specific period. It smooths out the effects of volatility and provides a clearer picture of long-term performance. This metric is especially useful when comparing funds with different timeframes or investment strategies. By focusing on annualized return, you can better assess how consistently a fund has grown your investment year after year. Comparing a fund's performance to a benchmark index is a standard way to evaluate its effectiveness. A benchmark is typically a market index that represents the segment the fund invests in, such as the S&P 500 for U.S. stocks. By measuring returns against the benchmark, you can see if the fund is outperforming or lagging behind the market. This comparison helps you judge whether the fund manager is adding value through their investment choices. Alpha is a metric that measures a fund manager's ability to generate returns above the benchmark, after adjusting for risk. A positive alpha indicates the manager has added value, while a negative alpha suggests underperformance. Alpha is especially important for actively managed funds where the goal is to beat the market. By tracking alpha, investors can assess whether a fund's higher fees are justified by superior performance. Beta measures a fund's sensitivity to market movements. A beta of 1 means the fund moves in line with the market, while a beta above 1 indicates higher volatility. Conversely, a beta below 1 suggests the fund is less volatile than the market. Understanding beta helps investors gauge the level of risk they're taking on and whether it matches their risk tolerance. It's a key metric for building a balanced portfolio. Standard deviation is a statistical measure of how much a fund's returns vary from its average over time. A higher standard deviation means more volatility, while a lower one indicates steadier performance. This metric helps investors understand the range of possible outcomes and the level of uncertainty involved. By comparing standard deviations, you can identify funds that match your comfort level with risk and volatility. Sharpe ratio evaluates how much excess return a fund generates for each unit of risk taken. It's calculated by subtracting the risk-free rate from the fund's return and dividing by the standard deviation. A higher Sharpe ratio means better risk-adjusted performance. This metric is especially useful for comparing funds with similar returns but different levels of risk, helping you find the most efficient option. Sortino ratio is similar to the Sharpe ratio, but focuses only on downside risk or negative volatility. It provides a clearer picture of how well a fund manages the risk of losses, rather than overall fluctuations. A higher Sortino ratio indicates better performance relative to the risk of losing money. This metric is particularly useful for conservative investors who are more concerned about minimizing losses than maximizing gain. R-squared measures how closely a fund's performance tracks its benchmark index. It ranges from 0 to 100, with higher values indicating a stronger correlation. An R-squared close to 100 means the fund's returns move almost in lockstep with the benchmark, while a lower value suggests more independent performance. This metric helps investors understand how much of a fund's results are due to market movements versus manager decision. Tracking error measures the difference between a fund's returns and its benchmark. It's especially important for index funds, which aim to replicate the performance of a specific index. A low tracking error means the fund closely follows its benchmark, while a high tracking error indicates more deviation. This metric helps investors assess how well an index fund is achieving its goal of mirroring the market. Information ratio compares a fund's excess return over its benchmark to the amount of risk taken, as measured by tracking error. A higher information ratio means the fund is delivering more return for each unit of risk. This metric is useful for evaluating active managers who aim to outperform the market, helping you identify those who consistently add value. Yield measures the income generated by a fund, usually from dividends or interest, as a percentage of its current value. It's an important metric for income-focused investors who want regular payouts. Yield can fluctuate based on market conditions and the fund's holdings. By comparing yields, you can find funds that align with your income needs and investment goals. Distribution rate shows how much a fund pays out to investors, typically as a percentage of its net asset value. It includes dividends, interest, and capital gains distributions. This metric helps investors estimate the cash flow they can expect from a fund, which is especially important for those relying on investment income. Turnover ratio measures how frequently a fund's holdings are bought and sold over a year. A high turnover ratio suggests active trading, which can lead to higher transaction costs and potential tax implications. Conversely, a low turnover ratio indicates a more passive approach. Understanding turnover helps investors anticipate costs and assess the fund's investment style. Assets under management, or AUM, refers to the total market value of all assets managed by a fund. AUM is often seen as a sign of a fund's popularity and stability. Larger funds may benefit from economies of scale, but very large funds can also face challenges in maintaining performance. AUM can influence fees, liquidity, and investment strategy, making it a key metric to consider. Fund inception date marks when a fund was first launched. This metric helps investors gauge the fund's track record and experience. Older funds have a longer performance history, making it easier to evaluate their consistency and resilience through different market cycles. Newer funds may offer innovative strategies but carry less historical data for analysis. One category classifies funds based on their investment focus, such as equity, fixed income, or balanced funds. Knowing the category helps investors compare similar funds and align their choices with their financial goals and risk tolerance. Each category has its own risk-return profile, so understanding where a fund fits is crucial for building a diversified portfolio. Morningstar rating is a widely used system that rates funds from 1 to 5 stars based on risk-adjusted performance. While it's a helpful starting point, it's important to look beyond the stars and consider other metrics. The rating is updated regularly and can change as a fund's performance evolves. Use it as one tool among many when evaluating funds. Manager tenure refers to how long the current fund manager has been in charge. A longer tenure can signal stability and consistent strategy, while frequent manager changes may introduce uncertainty. Evaluating manager tenure alongside performance metrics helps investors understand the impact of leadership on fund results. Load fees are sales charges that some funds impose when you buy or sell shares. Front-end loads are charged at purchase, while back-end loads apply when you sell. Not all funds have load fees, and many investors prefer no-load funds to avoid these extra costs. Always check the fee structure before investing to understand the true cost. Redemption fees are charges for selling fund shares within a certain period after purchase. These fees are designed to discourage short-term trading and protect long-term investors. Redemption fees typically decrease or disappear after a holding period. Understanding these fees helps you plan your investment horizon and avoid unexpected costs. 12b1 fees are annual marketing or distribution fees charged by some mutual funds. They cover advertising, promotional expenses, and sometimes commissions to brokers. These fees are included in the fund's expense ratio but can add to the overall cost. Always review the fee breakdown to understand what you're paying for. High portfolio turnover can lead to increased trading costs and potential tax consequences for investors. While active management may offer opportunities for higher returns, it's important to weigh these benefits against the extra costs. Reviewing turnover alongside performance and fees gives a more complete picture of a fund's efficiency. Liquidity refers to how easily you can buy or sell shares of a fund without affecting its price. Most mutual funds offer daily liquidity, but some specialized funds may have restrictions. Understanding liquidity is important for managing access to your money and planning for unexpected needs. Many funds require a minimum investment amount to get started. This threshold can vary widely, from a few hundred to several $1,000s. Knowing the minimum investment helps you plan your entry and compare accessibility across different funds. Some funds may waive minimums for retirement accounts or automatic investment plans. Unstyle describes the investment approach, such as growth, value, or blend. Growth funds focus on companies expected to grow faster than the market, while value funds invest in undervalued stocks. Blend funds combine both strategies. Understanding fund style helps you align your investments with your financial objectives and risk preferences. Sector allocation shows how a fund's assets are distributed across different industries, such as technology, healthcare, or finance. This metric helps investors understand the fund's exposure to various economic sectors and assess diversification. Sector allocation can influence risk and return, especially during market cycles that favor certain industries. Geographic allocation details the regions or countries where a fund invests. Some funds focus on domestic markets, while others have a global or emerging markets emphasis. Understanding geographic allocation helps you manage international risk and take advantage of growth opportunities around the world. Top holdings reveal the largest investments within a fund's portfolio. Reviewing these can give you insight into the fund's strategy and potential risks. Concentration in a few holdings may increase risk, while a more diversified list can offer stability. Always check the top holdings to ensure they align with your investment philosophy. For bond funds, credit quality measures the financial strength of the bonds held. Higher credit quality means lower risk of default, while lower quality can offer higher yields but more risk. Understanding credit quality helps you balance income needs with risk tolerance, especially in fixed income portfolios. Duration measures a bond fund's sensitivity to interest rate changes. A longer duration means greater price fluctuations when rates move, while a shorter duration offers more stability. This metric is crucial for managing interest rate risk in your portfolio, especially during periods of changing economic conditions. Maturity refers to the average time until the bonds in a fund's portfolio are due to be repaid. Shorter maturities generally mean lower risk and less sensitivity to interest rates, while longer maturities can offer higher yields but more volatility. Understanding maturity helps you align your bond investments with your risk and income preferences. Fund's dividend policy outlines how and when it distributes income to investors. Some funds pay dividends regularly while others reinvest earnings. Knowing the policy helps you plan for income needs and understand how returns are delivered. Always review the dividend policy to ensure it matches your financial goals. Tax efficiency measures how well a fund minimizes taxable distributions to investors. Funds with high turnover or frequent capital gains distributions may create higher tax bills. Tax-efficient funds are especially important for investors in higher tax brackets or those investing in taxable accounts. Reviewing tax efficiency can help you keep more of your returns. Every investment involves balancing risk and return. Fund metrics help you understand this trade-off by quantifying both aspects. Higher returns often come with higher risk, so it's important to find a balance that matches your goals and comfort level. By analyzing risk-return metrics, you can build a portfolio that fits your unique needs. Consistency measures how reliably a fund delivers returns over time. Some funds may have high average returns but with significant ups and downs, while others offer steadier performance. Evaluating consistency helps you avoid surprises and choose funds that align with your risk tolerance and investment timeline. Drawdown measures the largest decline from a fund's peak value to its lowest point over a specific period. It's a key indicator of downside risk and helps investors understand potential losses during market downturns. By analyzing drawdowns, you can assess a fund's resilience and your own risk tolerance. Volatility refers to the degree of variation in a fund's returns over time. High volatility means larger price swings, while low volatility indicates more stable performance. Understanding volatility helps you set expectations and choose funds that match your comfort with market fluctuations. Comparing a fund to its peer group, other funds with similar objectives, provides context for its performance and risk. Peer group analysis helps you identify top performers and avoid funds that lag behind. Always consider how a fund stacks up against its competition before making investment decisions. Transparency refers to how openly a fund discloses its holdings, strategies, and fees. High transparency builds trust and allows investors to make informed decisions. Look for funds that provide regular, detailed reports and clear explanations of their approach. Transparency is a sign of good governance and investor focus. We've covered a wide range of fund metrics, from performance and risk to fees and transparency. Understanding these metrics empowers you to make smarter investment choices and build a portfolio that fits your goals. Remember, no single metric tells the whole story. Use a combination to get a complete picture. Keep learning, stay curious, and use these insights to navigate the world of funds with confidence.